Remember when I told you to watch NEO at $4.73? Well, guess what happened? While everyone else was panicking about the recall, institutional money just made their move. This is Smart Stock Sam, and I'm about to show you why NEO's next breakout could send this stock parabolic in the coming week. Here's what's actually happening right now. The world's biggest financial institutions just staged a massive position buildup in NEO, and most retail investors completely missed it. We're witnessing something I've been calling the structural pivot, where NEO transforms from a speculative electric vehicle startup into a high-margin technology and energy network. Today, I'm breaking down the explosive data from the week of February 9th that validates why this could be the setup of the year and why a gamma squeeze could ignite as early as Tuesday morning. But to understand why the smart money suddenly got so aggressive, we need to look at how NEO just survived its ultimate stress test. The results completely changed the long-term thesis. Every strong buy rating eventually faces a trial by fire. NEO's happened on February 9th, when the company got hit with a massive 246,000 vehicle recall, the kind of news that usually sends a growth stock into a death spiral. But here's what's fascinating. The market absorbed the news. Institutional accumulation prevented any crash. And most importantly, NEO confirmed they're pivoting to an adjusted operating profit of between $100 million and $172 million for Q4. While the headlines screamed about a software glitch, the whales were laser-focused on the fact that NEO is finally printing money. So how could a stock hit by terrible news actually become more attractive to Wall Street? The answer is hidden in the price action of the last 5 trading days. This chart tells the entire story. It's a textbook anatomy of a bear trap. On February 9th, the recall news dropped and the stock gapped down to a weekly low of $4.73. To the average observer, it looked like the end. But watch what happened next. The moment the price hit that level, it was met with a wall of buying. Positive catalysts like the 100 millionth battery swap and record 125,000 Q4 deliveries acted as rocket fuel, sending the price to a high of $5.11 by February 12th. We ended the week at $4.95, coiling tightly just below a major breakout level. But that 473 level wasn't just random. We call this the Death Valley defense. Look at the candlestick action. Every time the price tried to dip lower, it was met with calculated institutional buy orders. This is algorithmic absorption in action. While retail was selling out of fear, big players were using that liquidity to fill massive positions at a discount. The rejection of these lower prices signaled the definitive end of the bear trend and the start of a new institutional floor at $4.73. And while the price was stabilizing, NEO's operational engine was running at full throttle. Numbers don't lie. NEO didn't just meet expectations, they shattered them with 125,000 Q4 deliveries, an all-time record high. But the real story is the cumulative 100 million battery swaps. This isn't just a convenience feature, it's a data-rich energy network that creates a massive competitive moat. While these growth numbers look incredible on the surface, there's one hidden financial metric I'm about to show you that changes their entire balance sheet. But first, we need to talk about the money side of these batteries. NEO has figured out a way to turn heavy assets into light cash. This is the Mirattery REIT model, and it's a masterstroke of financial engineering. NEO is taking its heavy assets, the battery packs, and moving them into investor-funded pools. By issuing $72.5 million in REITs and securing $145 million in new financing, NEO has effectively de-risked its balance sheet. They get the benefit of the network without the crushing weight of the debt. This is how you scale a global energy network while staying lean. This financial wizardry is the direct reason why the next chart looks so different from NEO's past. For years, the bear case was simple. NEO is a cash bonfire. That narrative is officially dead. We're looking at a fundamental narrative flip from cash burn to profit generation. With a projected $100 million to $172 million in adjusted operating profit for Q4 2025, NIO has crossed the Rubicon. When a growth company becomes self-sustaining, the way Wall Street values them changes overnight. They stop being valued on hope and start being valued on earnings multiples. And they're not just doing this in China, they're taking this profitable model global. Look at the map. NIO is rolling out its Firefly brand via an asset-light expansion strategy. By partnering with DHL for European logistics, they're bypassing the billions in costs required to build their own warehouses and delivery fleets. They're essentially plugging into DHL's existing infrastructure to dominate the European aftermarket. It's a brilliant move that allows for rapid scaling with minimal capital expenditure. When you see a strategy this clean, you better believe the whales notice. If you want to know where a stock is going, follow the smart money. The latest 13F filings are staggering. JPMorgan Chase increased their position by 268%. BlackRock added over 5.5 million shares, a 153% jump. Even Goldman Sachs re-entered with a 58% increase, holding nearly $73 million in value. These aren't retail diamond hands. These are the most sophisticated capital allocators on earth, and they're buying NIO at the $4 and $5 level. So what do these geniuses see that the average investor is missing? They see a massive valuation gap. At the current price of $4.95, NIO is trading at a 20% discount just to hit its conservative fair value of $6.24. But if you look at our bull case target of $8, we're talking about a 60% upside from here. You're essentially buying a profitable global technology network for the price of a struggling startup. But there's a technical engine under the hood that might force this price up much faster than the analysts expect. Look at the call wall. There's a massive concentration of 66,867 call contracts sitting right at the $5 strike. Here's the mechanics. If NIO breaks and holds above $5, it forces market makers to buy millions of shares to hedge their positions. This creates a feedback loop. Price goes up, market makers buy, price goes higher. We're currently sitting just 5 cents away from the trigger. And the shorts? They're already starting to scramble for the exits. Short interest is at 141.69 million shares, but look closely. Covering has already started. With 3.28 days to cover, there simply isn't enough liquidity for the shorts to escape if a price spike occurs. This represents a high squeeze probability. When those shorts are forced to buy back shares at the same time market makers are hedging the $5 calls, the move could be parabolic. Now, none of this matters if there isn't a fundamental catalyst to keep the momentum going. That catalyst arrives on April 10th with the ES9 flagship launch. This is NIO's strategic bridge across what CEO William Lee calls Death Valley. The ES9 is expected to drive massive Q2 volume and re-establish NIO as the dominant player in the premium SUV segment. This isn't just another car. It's the revenue engine for the rest of 2026. So how do we actually trade this? Here's the game plan for the next week. Before we wrap up, remember this is for educational and informational purposes only. Nothing I say should be considered financial advice. Always do your own research and consult with a licensed financial advisor before making any investment decisions. Trading stocks carries significant risk, and you can lose money. Here's your tactical roadmap. Our entry zone is $4.95 to $5.05. We want to be positioned before the $5 breakout. Our support and stop-loss level is firm at $4.73, this week's Death Valley floor. On the upside, our first target is $5.53 to reach the break-even point for the call wall, followed by the $6.24 fair value, and eventually our $8 bull case. This is a high-conviction setup with clear risk-reward parameters. Ultimately, we have to realize what NIO has become. The verdict is clear. NIO is a strong buy. We've moved past the era of speculation. Institutional validation is complete. NIO has successfully transitioned from a car company to a global energy and technology network. The whales are in, the profits are here, and the $5 breakout is the next major step in this journey. If you found this analysis valuable, Smash that like button and subscribe to Smart Stock Sam for more deep dives. I'll see you in the next one.